On the 12th of June, a crowd gathered outside a building in New York and cheered for a rocket company. For the first time in over 2 decades, ordinary people could finally buy a piece of SpaceX, the largest stock market debut in history. $75 billion raised in a single day. A company worth more than almost any other on Earth, opening its doors to the public. And somewhere in Australia, watching the headlines roll in, a quiet voice in the back of your head said, "Don't miss this one." That voice has a name. It's called FOMO, the fear of missing out. And today, I want to show you precisely what it costs, using the most exciting IPO any of us will ever see as the teacher. Because 2 weeks later, the story already has an ending, and it isn't the one the crowd was cheering for. Here's the thing almost nobody explains about an IPO. There isn't one price. There are two. And you almost certainly didn't get the one that mattered. The first is the offer price. For SpaceX, that was $135 a share, the price written into the prospectus, the price the company actually sold at. The price that, this morning, would have left you sitting on a comfortable gain. But you couldn't buy at $135. Almost nobody outside the room could. Those shares went to large institutions, to insiders, to the favored clients of the banks running the deal. By the time the stock reached you, a regular person on a regular screen, it was already loose on the open market, trading at whatever price the excitement had pushed it to. That is the second price. And the second price is the one you pay. So let's follow the money, because SpaceX has handed us a perfect 2-week experiment. The stock opened, and it did what hyped IPOs do. It surged. It closed its first day near $161, up 19%. The headlines wrote themselves. 4 days later, it touched $225, 67% above the offer price. The crowd looked right. The rocket was going up. And then, it came back down. 3 straight days of selling. Within a week, it had fallen to $147. As I record this, it sits around $153. Now, hold 2 people in your mind. The institution that bought at $135 is up around 13%. Quietly, comfortably ahead. But the everyday investor, the one who saw it climbing, who didn't want to miss it, who bought near the top at $225, that person is down more than 30% in 11 days. On the most celebrated company of the decade. Same stock, same fortnight. 2 completely opposite outcomes. The only thing that separated them was the price they paid, and which side of the IPO they happened to be standing on. And here's where it stops being one story and becomes a pattern. A finance professor named Jay Ritter has spent more than 30 years studying what happens after companies go public. Not the first day fireworks, the years that follow. And his finding is remarkably consistent. When you measure from the price, an ordinary investor actually pays. That first day's closing price, new listings, on average, tend to trail the wider market over the years that follow. His original research found new listings returning around 34% over 3 years, while comparable, established companies returned nearly 62%, a gap of almost 28 percentage points. Not because the businesses were bad, because the entry price was too high. Ritter put it with surgical precision. The problem, he said, isn't that the offer price is too low. It's that the first market price is too high. And he found something sharper still. The IPOs that disappoint the most are the ones priced at the most extreme valuations. Companies valued at more than 40 times their annual sales. In that group, the large majority go on to lag the market. So where does SpaceX sit? At its IPO, SpaceX was valued at roughly 94 times its annual sales. Today, closer to 110. More than double the level Ritter flags as the danger zone. And this is a company that, for all its brilliance, lost around $5 billion last year. Now, I want to be careful here. SpaceX may well turn out to be one of the great companies of our era. Starlink is real. The rockets are real. I am not betting against Elon Musk reaching Mars, but that was never the question. Because here is the lesson sitting underneath all of this, the one I want you to carry out of this video. A great company is not the same thing as a great investment. Whether a company succeeds is a question about the business. Whether you succeed is a question about the price you paid. Two different questions, and the entire machinery of an IPO is designed to make you forget the second one. The crowd outside that building wasn't really cheering for a stock. They were cheering for a story, a rocket, a founder, a piece of the future. And stories are wonderful, but you don't get paid for owning a story. You get paid for buying a real business at a sensible price and then waiting. Which brings us to the quiet irony in all of this. If you own a low-cost index fund, the boring kind I talk about on this channel, you will own SpaceX anyway, automatically, as it earns its place in the index at whatever price the market eventually settles on. With none of that panic, none of the guessing, and none of the fortnight that just erased a third of someone's money. You never had to catch the rocket on launch day. You just had to be on the long flight. So if you take nothing else from today, take these. 1. Separate the company from the stock. Admiring a business is not a strategy. Always ask what you're paying, not just what you're buying. 2. Know which price you're getting. If you're a regular investor buying an IPO on day 1, you are not getting the offer price. You're getting the crowd's price. Assume it's high. 3. If you truly want to own a newly listed company, wait. Let the excitement fade. Let the insider lockups expire. Let the company report real numbers as a public business, quarter after quarter. The stock will still be there. It is almost never a now or never decision, no matter how loudly it feels like one. 4. Size it honestly. A speculative bet is money you can afford to lose, sitting at the edge of your portfolio, never the foundation of it. And 5, for those of us investing from here in Australia, remember that owning a United States listed stock layers, currency swings, and United States tax paperwork on top of everything else. More moving parts, more ways for the maths to surprise you. The rocket may well reach Mars. I genuinely hope it does. But your financial future was never going to be decided on a single Friday in June by whether you managed to grab a sliver of the most hyped stock of the year. It's decided by the boring things. The price you pay, the patience you keep, the temptation you quietly walk past, the crowd chased the launch. The disciplined investor was already on the longer, quieter flight. The one that compounds year after year, long after the cameras have packed up and gone home. That flight doesn't sell out. There's always a seat. I'll see you on the next one.